What's going on? Alex here, and I'd like to welcome you to yet another Efros Financial Power Hour. That's right, grab your favorite beverage, lean back, and enjoy the beautiful finance that we're about to discuss. I'm excited. I hope you're excited as well. With that, we've got the call-in ready to go. We've talked about this in a prior live stream, but bam! There's a phone number. Call it up. If you have something to add to the conversation, if you have a question, don't be shy. We haven't had a brave soul yet who has called the number, but I encourage you to do so, and we'll take it from there. And with that, as always, we're going to get into some Reddit questions about taxes, accounting, bookkeeping, all that good stuff, and that's going to start right now. All right, so the first question comes from the bookkeeping subreddit and goes as follows. Adjusting entries to fix severely neglected books. Let's read. I just picked up a new client who has several years of neglected books. This is, I'm assuming, a bookkeeper who provides services for clients. They asked me to clean up the books and maintain them going forward. But the problem is, it's completely impossible to fix the historical data. Among other items, the client doesn't have access to bank/credit card statements going all the way back to inception, and their invoicing procedures or lack thereof are concerning. I'm inclined to book a bunch of outrageous adjusting entries as of the beginning of tax year 2022 in an attempt to maintain accurate books going forward, but I'm not aware of all the effects this may have. For example, one entry I want to book would be able to clear out $1.5 million in undeposited funds, and the offset would end up on the income statement. However, this severely throws off the net income, and I don't want to get the client in tax trouble, which a separate accounting firm handles their taxes. I gave the client several examples, and they were very nonchalant about it and swore they weren't too worried about the effects. Has anyone handled a situation similar to this? What did you do? What were the effects? Any and all advice would be appreciated, as I'm hesitant to officially take on this client. And this goes to the topic of messy books. As a CPA who does accounting and bookkeeping, who does tax preparation, I can't tell you how many times we get tax supporting information that is an absolute disaster. And the issue is that when you complete a tax return, you're signing it as the taxpayer under penalty of perjury. So if your books are a mess and they don't accurately reflect what happened throughout a particular tax year, then it's likely that the tax returns that you're going to file are also going to be incorrect. And they may understate income, they may understate your tax liability, and you're taking responsibility for that by signing on the dotted line. And that issue goes back to the accounting and bookkeeping. And out of all the business expenses that startups have, this is an area where skimping will cost you later. It'll cost you more. It'll cost you more in headaches, and it's not worth it to allow your books to become a disaster. Because this situation is exactly what happens, in that you try to make it right. You want to do an about face and do it right moving forward. The issue is that there's going to be hesitation on the part of any professional in terms of even touching the stuff. Right? Because the question is, when the problems started, have they always been messy in terms of the books? Is this something that was good until 2018 and afterwards, let's say a bookkeeper was fired, a spouse was no longer a spouse, what have you, and at that point it went off the rails? Or is this something that just affects this tax year? And that's going to determine the amount of work that we have to do to get all of this back on track, because as you can see, this bookkeeper here is trying to just make it right and go forward accurately. But the problem is there's $1.5 million entry that they have to figure out what to do with. So $1.5 million in undeposited funds. That means cash, right? So cash went in the hand, but it didn't hit the bank account. So the question is, where did it go? We all know cash has a tendency to come and disappear and all of this good stuff. And the question is there a $1.5 million in undeclared income from prior years? And who knows where the other side of that entry is, because in double entry accounting, there's the debit to increase the undeposited funds. Where did the credit go? It may not have gone to income, which means this $1.5 million may not have hit the income statement. Now, that could be an understatement of $1.5 million just from 2021 as one tax year, or we could have misstatements of $150,000 each year for the last 10 years, which all ended up in undeposited funds to the amount of $1.5 million. Now, the question is, how far back do you go? And if the books were always a mess, do you have to go back to day one? It's a good question. From a technical standpoint, when you look at income taxes, the tax code would want you to get it right for each particular tax year. So if the tax return from 10 years ago was incorrect, you have to file or amend the tax return from 10 years ago, and so forth and so on. Some CPAs out there, and I've been around, so I can tell you in the real world, they'll just say, just book all of the adjustments in the current tax year, okay? Don't bother going back, don't amend. It'll not make too much of a difference from one year to the other in terms of the tax rate, so just clear it all out in 1 year, don't amend, and do it right moving forward. That's not technically correct, but that is an approach that some firms out there take. I always advise clients to do it the right way, do it right, keep it tight, and you don't have to worry about it moving forward. But this is a great demonstration of what you end up looking at because you have a bookkeeper who doesn't even want to get involved, because there's so many other clients out there who are excellent, who have clean books, who respond on time, who do reconciliations, or have a great bookkeeper that takes care of all this. But if you let the issues compound year over year, you have this situation where there's a potential $1.5 million adjustment. We're not talking about peanuts here. Sometimes when the books are off by a little bit, we might be able to book an entry to office expenses or something like that. If we're talking about small amounts, right? Clean up the books, don't make a big deal out of it. Nobody needs to amend a tax return over $200. Nobody cares. But when we're talking about figures with a number of commas in it, then it turns into a different story, and we have to be a lot more careful with how we approach this. The other issue is that often when we see a $1.5 million discrepancy in terms of the accounting and bookkeeping, it's actually not a $1.5 million issue that we find out after digging in, looking a bit more at it. We find out that it's $4.5 million in one direction and $3 million in the other direction to net out to 1.5, because when the books are a disaster and entries are being booked all willy-nilly by people who aren't familiar with accounting, that may very well be the case, and that once you actually look into it, you realize that the problem, instead of being this big, is actually this big, and that increases the amount that you may have to adjust in prior tax years. Now, put yourself in the position of a client that has messy books. They've already made the decision that they're going to skimp on this, right? They're going to get the cheapest bookkeeper, or they're going to do it themselves, or they're going to have the spreadsheet from hell. Oh, God, don't get me started on the spreadsheets. That's where all the gremlins hide. And now they're looking to you to make it right. So from their perspective, they just feel like, yes, we got to fix where it is now and do it right moving forward. But as a professional, you know that there's a tremendous amount of work to do before we even get to the current year, because there may be 10 years of understatement in terms of income and taxes that this client has, which means they may have to amend S-Corp returns for all of those years. Again, assuming you're going to do it right, not the quick and dirty way, just by adjusting 1 year. So if they have to amend the S-Corp returns or the partnership returns, they may also need to amend the personal returns for all of the S-Corp owners and or partners of the partnership. How many tax returns will that be? Okay? And that's why you're going to get pushback from these sorts of clients that say, no, that's too expensive. We don't want to do it that way. We just want you to smush everything into the current return, do it in 1 year, and figure it out. And you will have professionals just like this person who say, you know what? No thanks. Please take your business elsewhere. All right? And more this is becoming the case because accounting is apparently a dying art. All right? Not many people are majoring in accounting, and good bookkeepers are becoming fewer and further between. So this situation is actually quite common in that you'll bounce from one professional to the other, to the other, to the other, and none of them are going to want to help. All right? So in this situation, the solution that I propose is that we search for the last known good. information, right? So if this client had a CPA up until, let's say, 2016, and then they decided to do it themselves, then we very well might have a last known good balance sheet and income statement in 2016, because that's when the work was done by a professional. And from there, we can use that as a baseline to rebuild 2017, 18, 19, 20, and so forth to get to where we are being tax year 22. So that'll be expensive, it'll be time consuming, but that's the way to do it right. What's likely going to happen is that this individual is going to find somebody, they'll say, I'll just take the 1.5 million, kick it into expenses for the year and create a loss. Who cares? Well, what can happen then is that once you file that return, the good old IRS and the good old states are going to be saying, wait a minute, your income was really high in the last few years, and then all of a sudden it dipped into a loss. We want to see the books. And then you're going to realize why you shouldn't skimp on accounting and bookkeeping, because you're going to get hit, and you're going to get hit hard, because they'll adjust every single tax year where you weren't wrong, not just the 1 year where you decided to try to make it right using the quick and dirty method. Okay? And we're going to touch a little bit more on problem clients, difficult clients, a little later in this live stream. In the meantime, if you're hanging out and you're liking the video, hit that like button, would you? Just smash it. It's free, not going to cost you a dime, and it lets me know you guys are digging the content, which is always good to hear. All right? So that's the solution in this situation. Now, in terms of taking on this client, it would very much depend on their perspective in terms of how open they are to making this right, and if they're willing to be all in on the effort to fix it. Because if they continue to be nonchalant and they swear they're not very worried about it, they may not understand the extent and seriousness of the work, in which case it may not be a good fit from a client perspective. All right? And you could just tell the clients, hey, unfortunately, it's not a good fit. Wish you all the best. And that's something that more professionals should do, in my opinion. All right? Okay. Drop some comments in the live chat. If you guys are hanging out, you've got something to add to the conversation as we move on to the next question. This is from the tax subreddit and goes as follows. Can I buy a Nissan Leaf for the federal tax credit and also file a Section 179 with bonus depreciation if I use it for ride sharing for the rest of the year? Would I be able to get the $18,500 deduction as long as I use it less than 50% for rideshare? This is in the state of California. All right. Now, the federal tax credit for electric vehicles has received an update lately, so there have been a lot of questions about this. And they really have to do with, am I eligible? What is the amount? How does it work? Well, we're going to get into that. The first question that you have to address with regard to the vehicle credit is whether the vehicle is even eligible for a federal tax credit. And for that, there's a handy dandy website here, and I'm going to drop the link in the chat below so you guys can check it out. And what it deals with is the fact that vehicles by certain manufacturers have phased out of the credit. So, for example, Tesla, let's go down and take a look at them. You'll see that the phase out has been initiated, and for all of these vehicles, the credit is currently at 0 as of 1/1/2020. So we've had a lot of taxpayers reach out and they said, hey, here's my Tesla purchase agreement. I want the credit. Well, we have to tell them the bad news in that taxpayers may claim the full credit up to the end of the first quarter, after the quarter in which the manufacturer records the sale of its 200,000th qualified vehicle. For the second and third quarters, taxpayers may claim 50% of the credit. And for the fourth and fifth calendar quarters, taxpayers may claim 25%. No credit is allowed after the fifth quarter. And that's the phase out that you're seeing here. Over time, what happens, that's the price of being successful, is that certain manufacturers, Tesla included, have sold enough vehicles to which no more credit is available. But we weren't talking about Tesla before. We were talking about Nissan. So we scroll up to where we have the Nissan info, and let's take a look. So we've got the Leaf. Can we claim the credit for 2022 and 2023? The answer is yes. So we've got $7,500 in terms of the credit. But how does it work when you have a credit available and a deduction available for the same amounts? Can you take both? Well, let's take a look at the form that's used to claim the vehicle credit, which is 8936. And if we pull up this handy dandy form, we can see that it's pretty straightforward, nothing too crazy here. All right. And you'll see that it basically asks about the information about the vehicle and allows you to calculate the credit. Now, if we look at the instructions for this form, we'll see more information, which will include the fact that when you claim the vehicle credit, you may have to reduce the basis of each vehicle by the sum of the amounts entered on lines 11 and 18 for that vehicle. Lines 11 and 18 happen to do with the credit amount itself. All right. So what that means is that if you start with a basis of $20,000, let's say the vehicle costs $20,000, and you take the $7,500 credit, what's happening is you have to subtract that $7,500 from the $20,000 to get the basis, which you can then use for depreciation. You cannot get a double benefit when it comes to a credit and a deduction, and that is the case with a majority of the tax benefits that are out there. One of the things Congress hates is when taxpayers get a double benefit. They cannot stand that. So often, if you have a benefit in one place, you lose the benefit in the other place. And in a number of tax projections, what we typically do is assess whether it's beneficial for the taxpayer to claim the credit or the deduction. Typically, it's better to claim the credit, but depending on the overall tax return, right, you can have, it's like a stew. You can have different ingredients, and depending on one little change, it may change all the others as well. So in some cases, the deduction is beneficial. In some cases, the credit is beneficial. So you can run both scenarios and see which one works out to be more advantageous. All right. So that is how the credit works with regard to electric vehicles. And you can get the credit and also take depreciation, Section 179, but you have to reduce the basis of the vehicle by the amount of the credit to avoid a double benefit. Okay? All right. With that, if you guys are hanging out, drop some comments down below. If you have questions, I'll be happy to answer them as we move on to the next question. And this is a sister question. It's going to have to relate to the other question that we're going to look at. They're kind of similar, so we're going to group them up and we're going to discuss them and take them from there. Now, once again, if you guys are hanging out, like the video, subscribe to the channel, share it, all that good YouTube-y stuff. All right. In this question, this is from the small business subreddit, moving around a little bit, moving and grooving. Fourth and smallest client is the most demanding. I want to fire them, but need someone to push me. Small business owners out there, I know there's a number of you that watch. Don't you have clients that drive you crazy? Don't you have the ones that when their name comes up on the caller ID, you go, oh my goodness, anybody but this person, right? I've certainly had those. And as someone who started businesses from scratch, I could tell you that when you start out, you tend to get a lot of these because the bigger firms already said no to them. So you end up with this wonderful funnel of clients that, let's just say, may not be ideal. And as a business owner, you need to know how to handle that. So let's read. I'm a new small business owner. I have a small consultancy business for software product management. I have 4 clients in total. Client 1 is the highest paying, very flexible. All right, notice highest paying, very flexible. Wonderful attributes to have. Client 2 is the next highest paying, maybe 3 to 4 hours of work weekly. Okay, again, sounds to be low maintenance. And let's make sure you guys can see this. Client 3 is a part-time contract, not that big, but very flexible too. Okay. Now we get to client 4. Small business owners, let me know out there if you've experienced this yourselves. Client 4 is the lowest paying, all things considered, and the most demanding. Wouldn't you know it? Very little flexibility. It's a startup, so they expect me to do all their processes as well. So not only consult, but also do the work. It's difficult and there's very little organization. This is definitely a lesson learned, but the reason why I took this is because I loved their product. But now, not so much because it's eating up so much of my time. Sometimes to the point when I'm putting client one on the back burner for this. Oh my goodness. Which is wrong because client one is the highest paying. There are also weekends on client four, and I feel that if I have to stop what I'm doing with my family and have to attend a 30-minute meeting on Saturdays, that I should feel guilty. I think I know what I have to do, but I'm getting discouraged, and I think I want to know what other business owners would think of this. Well, let's look at the sister question, and let me know what you guys would do in this situation in the comments below. Way to fire a client that is family. Okay, this is another group of potentially difficult clients. If you guys are business owners, you know. Long story short, hired in 2021, lots of issues, lack of communication, work is very understated in terms of scope. Big problems getting paid. They would be weeks late. Fired me for 1.5 months, replaced me with a company that sucked, and begged me to come back. Okay. Same issues this time around. Had a phone call with them and they were upset I stopped work for 5 days due to unpaid invoices. 5 weeks worth, $1,500. Honestly, didn't say anything this time around. I just stopped the work. I was tired of having to hound and ask for my money, so I said, screw it. There's no contract in place, and this is more of me helping them out with extra work. Need some help with some professional ways to fire this client. I'm chasing my money down, and I'm taking a huge pay cut to help out, which takes up a large part of my work. 15 hours a week, and it's draining. Okay. Any business owner has experienced difficult clients. And actually, right now, in where we are in tax season, we're having to deal with some of this as well. Being that it's the end of September, we're nearing the extended deadline for the personal income tax returns, which is October 15th. And we start the tax preparation process way early in the year. In the middle of January, we send out all of the emails, all of the links and everything to get clients started so they can start uploading information and filling out our tax questionnaire and all that good stuff. That allows an extraordinary amount of time for clients to provide their info. And as soon as we get information, we hit the ground running, we get working on it. We get more information, we hit the ground running. At this point, given that we're 2 weeks away from the deadline, we still have a number of clients that have not sent us any tax supporting information, or they're just starting to remember that they had rental properties and schedules K1 that came in and all this other information that they're dumping on us right at the beginning of October. And when I started out, when I was first sharpening my teeth at that self-employment game, I can tell you that I would eat this up, meaning that if I had to eat hours to help a client, I would do it. If I had to put in 18-hour days 2 weeks before the deadline, 7 days a week, I would do it. Because first of all, nobody else was paying the bills for me, so I had to do it. And second of all, there weren't enough clients to where I had the ability and privilege to fire any of them. So when you have a small business and you are just taking on your first clients, you're going to get a whole bunch of them that are not ideal. But your responsibility as a business owner, as you build, as you structure it in a way where you have a number of clients, you have the good ones and the bad ones, it's up to you to start firing the bad ones. Some companies, I know that they take their 10% of the most PIA, pain in the ass clients, and they straight up fire them every single year just so they can work with the people that are like client one in this first example, where they take up the least amount of stress and they pay the most. Okay? How do you determine this? Because that's the other question, right? After you finish working with hundreds of clients, you don't remember who's who anymore. And I realized that that was a problem in my firm because I knew that there were some names that stuck out in my head where we might have to make a change and politely ask them to take their business elsewhere. But I didn't have a system in place. So every year, we skip that process, right? So we have a difficult client in 1 year, they're a difficult client in the next year, difficult client in the next year, and they're eating up a tremendous amount of time. All right? And if you guys take nothing else away from today, if you get nothing else out of this live stream, just know a little concept known as the Pareto principle, okay? And that's also known as the 80-20 rule. What is it? Okay. It's a very simple principle which states that for many outcomes, roughly 80% of the consequences come from 20% of the causes, otherwise known as the vital few. What does that mean? It's a little abstract. Well, it just so happens that when you observe economics, anthropology, many other facets of life, if you just look at the numbers, you will see that 80-20 seems to be a ratio that exists in many different facets of life. For example, there was a report that showed that the distribution of global wealth is very uneven, with the richest 20% of the world's population receiving 82.7% of the world's income. 80-20. Okay? Now, there are other aspects of this in that 20% of the hazards account for 80% of the injuries. Think about that. Think how powerful that is. Okay? And this seems to apply in very many aspects. All right? For example, video rentals. Remember renting videos? Remember going to Blockbuster? Many rental shops reported that 80% of revenue came from 20% of videotapes. Isn't that a little strange if you think about it? Backing up a little bit, a New Zealand study found that by the age of 38, 22% of children accounted for 81% of criminal convictions, 78% of pharmaceutical prescriptions, and 66% of welfare benefits within the group. 80-20. Okay? In so many aspects. Now, you might say, what in God's name does this have to do with accounting, bookkeeping, taking on clients, and small business? Well, this image demonstrates it all. Every small business, I guarantee you, has the few clients who are the all-stars. They don't give you any trouble. They're a pleasure to speak to. They always provide information on time when you request it. And they're raving about you to their friends. When you look at it, you'll see that these people are the minority that contribute 80% of your revenue. The 20% that contribute 80%. It's a very powerful concept. This is what I'm wrapping my head around still to this day. And then on the other hand, you have the 80% of your clients which provide 20% of your revenue. These are the difficult ones. These are the ones that don't respond in a timely manner. These are the ones that piecemeal information over to you in an endless parade of documents. And they consume all of your time. But wait a minute. What if you just focused on this 20% a lot more? Because if you were to look at how you allocate your time, I guarantee you that you're spending most of your time dealing with this 80% that provide the minority of the revenue. And this 20%, the all-stars, struggle and pay the price for your lack of attention to them. And that's exactly what's happening here. Okay? 4 clients in total. 1 is the highest paying. That's the all-star, client 1. But as we can see, this person is spending an inordinate amount of time dealing with client number 4, who's a drag on the business. So what you do, you simply let them go. And how do you do that? I get a lot of questions from clients. They have clients that they need to part ways with, but they don't know how. The easiest way to do it is to keep the emotion out of it, keep the personal side out of it. Just say, factually, here's where we are. We started working together on this date. On this date, we requested this information. We didn't receive it until then. And then again, we requested the info. We didn't receive it until 2 months later. So what happens is, and then you explain from the fact pattern, here's how it affects this relationship. Okay? And you explain, well, given that, we have to analyze our operations on a periodic basis. And, there's clients that we work with who provide everything on time, who is able to really work with us in terms of facilitating what needs to be done. And there's another group of clients where we look at it and the amount of time that we spent just doesn't work from a business perspective. So unfortunately, we're not going to be able to work together moving forward. And if you base the message where you part ways on just the facts, don't make it you against me, personal, anything like that. No name calling. Just say, this is what happened. And unfortunately, it's not a fit. So we wish you all the best, but we're not going to be able to work together anymore. That's how you get rid of this 80% of clients that don't contribute to the bottom line. And you can be left with enough diligence on this, with just those amazing top tier clients that make your life a pleasure. Which I would advise this person to do over here. That's exactly what needs to happen. But you see the hesitation, guys? You see that this person was hesitant to let him go. They're posting on Reddit to figure out how to do that. Well, this is a real issue. And anybody that's watching with a small business, I know that you're keeping in mind this 80-20 rule. Okay? That's my advice. And I'm learning this every day. And there are several times throughout the year where we contact the clients that are these client fours, and we tell them politely that based on how things have progressed, unfortunately, it's not a fit, and we wish them all the best. One powerful tool in making that happen was actually tracking time, right? Clients ask, well, how do we know who's the Class A client versus the Class D client? Well, you look at the revenue, okay, and you look at the time spent, all right? This is where you have to track your time, okay? Now, in tracking these metrics, you can come up with the hourly rate. And different businesses call this different things. They call it realization. They call it revenue per client. But at the end of the day, you owe it to yourself as a business owner, because at the end of the day, this isn't a charity. You owe it to yourself to do the work and just analyze how you should be spending your time. Okay? So in this example, just to put some numbers on this, okay, let's say that a revenue for client A was $100,000. Okay? And the revenue for client B was only $40,000. Very often, this is where the analysis ends, because taxpayers or clients, what have you, will say, well, clearly client A is better. Okay? Here's the crucial missing link in that. How much time did you spend overall on client A? Now, you might have different levels. You may have administrative staff. You may have your hourly rate as the owner of the business. You may have 3 employees working for you. You need to figure out what all that costs, right? So there's a little bit of work involved in this. It's not magic. But let's say you spent 176 hours on this client, and on this client, you spent 42 hours. Very simple math here, guys. We divide. Okay? And we can see that even though client A is paying a lot of the revenue, the rate that you're realizing per hour spent on client B is almost double. All right? But if you're just looking at this information, you're getting it completely sideways, because so many businesses will say, you know what? Client A is our all-star. Clearly, because the revenue's there. When in reality, they might dump a client who's that Class A gold star client and end up with everybody who's difficult, everybody who has a lower realization rate. And overall, you're going to make your life a whole hell of a lot harder if you ignore these metrics. All right? This is why accounting and bookkeeping is so vital, because a lot of business owners can't even put these numbers together. They don't have the information. Okay? But once you have the info available, then it's very simple to pull all this into a spreadsheet and really get the numbers to speak for you. Because, again, so many businesses will expend all their time and effort trying to impress client A, where client B is where their attention should be focused. So, business owners ask me how to get rid of problem clients. I already told you. Stick to the facts. Lay out exactly what occurred and when, and just tell them that unfortunately it's not a fit and you wish them all the best. But you're done working together. In many cases, clients know that they've been difficult. They know that it's not been roses and honey dealing with them. And you shouldn't really worry about it because you're doing your business a tremendous service by making sure that you provide services to those top tier individuals and you're spending your time wisely. I don't know about you, but I'd rather be paid $1,000 an hour than 500. Fair? All right. And if you're hanging out, guys, leave a like on the video, subscribe to the channel. I see the like count and I'm crying inside because it's not where it should be, given the fact that you guys are hanging out to this point in the video. All right, so Pareto principle, very important. Now, as a different way to conceptualize the Pareto principle, there's a useful website here, betterexplained.com. Let's just look at a few of these examples just to really drive the point home, and then we'll move on. The Pareto principle helps you realize that the majority of results come from a minority of inputs. 20% of workers contribute 80% of the results. That's powerful stuff, okay? Let's think about that. 20% of the workers contribute 80% of the results. Now, what can you do to put this information in action is you focus on rewarding those employees because it's so easy to focus on the other 80% that are contributing 20% of the results. Think about it. Apply this to your organization. 20% of bugs contribute to 80% of crashes. All right? Focus on fixing those bugs first. And then 20% of consumers contribute 80% of the revenue. We've already talked about that. Focus on satisfying those customers. There's so many situations where we spend all of our time with the most difficult, lowest paying clients. You got to get rid of them. All right? No more sugarcoating it. No more delaying it. No more hesitating. No more asking questions on Reddit. Just do it. And you'll have a happier life. I promise you. Okay. Let's move on to the next question. I love that you guys are hanging out. Drop some comments down below so I know that you're with me. And we're going to take a look at a personal finance subreddit question here. And it goes as follows. Is my Edward Jones advisor an idiot or am I? Okay. I currently have a $400,000 account with Edward Jones. I want to secure $300,000 of it to pay for a new house in the coming year. Fair enough. Spoke to my advisor yesterday about moving that amount to CDs. Now, guys, let's just back up before we even read the end of this. What would you think would be the prudent move in terms of navigating risk and reward for an amount of money that you know you're going to need in a very short period of time? This is in the coming year. This person is going to make a down payment on a house. The Edward Jones advisor said that this wasn't a great idea because the economy is going to turn around after the midterms. So apparently he has a bright, beautiful crystal ball. He also said that the Fed isn't going to increase rates more. All right. Is he an idiot? I really need this money to buy a new house, and I don't want to lose it if the stock market tanks. If CDs aren't the best option, what is? Okay. Let's think about this, guys. $400,000 in the account invested in, I would assume, equities. So full-on stock market exposure, whatever happens, that's what happens, right? So if the market dips another 30% in the next year, well, I guess that's going to be a problem for our client here. Edward Jones apparently is leaning in the direction that it's crazy to pull money out of the market. It has dipped lower, and apparently they know, because they are able to see into the future, that the market is going to be a lot better and the Fed is done raising rates. How they know these two things, I have no idea, because I guarantee you that if anybody knew where the stock market was going with any sort of accuracy, they wouldn't be working at Edward Jones. Think about that. All right. So when looking at this, when we worked, and this goes back to the reason behind working with a fee-only financial advisor versus a broker who makes a commission. All right. And this goes back to when I was working at the investment firm. We were fee-only, which means that there were no commissions, no third-party compensation, no outside influence whatsoever. We were simply paid a fee to advise our clients on what to invest in and how to manage their portfolio. So from a fee-only perspective, the approach that we took is if you need the money within the next 2 years, not in the coming year, not in 18 months, if you need it in the next 24 months, you have no business investing that money in the market at all. Maybe you can put it into CDs. That's fine. But for someone to advise equity exposure, so full-on stock market roller coaster, for someone who indicated that they need the money within a year, this could be 8 months, is insane. It all goes back to incentives, right? You'd wonder, why would this Edward Jones advisor recommend this client to keep their funds invested? Well, this is what we call a conflict of interest, guys. Because the rate at which advisors at Edward Jones, I'm fairly certain, again, it's difficult to get any information out of them, but I would venture to say that, in my opinion, and my understanding of the business, they get paid a higher rate for you to stay invested in equities as their advisor compensation versus you staying in CDs. They don't get a high payout on CDs, so they don't want you to be in CDs. And if the stock market tanks another 20% in the next 8 months, the Edward Jones client following their advice would be screwed. Whereas a client who pulled their money out 2 years ago and put it into CDs is sleeping beautifully at night. All right, I can't stress enough the difference between commissioned brokers providing advice and someone who is a fee-only fiduciary, it's a very important word, telling you what is in your best interest, okay, regardless of compensation. Because as a fee-only advisor, whether a client has $500,000 in cash or $500,000 equities doesn't matter in many cases. Some firms charge less for amounts that are in cash in terms of management fee, but we can tell you that when you take the commissions out of it, when you take the bonuses out of it, there's much less of an incentive, if any, to recommend someone to stay invested when clearly they're expressing that they're nervous, that they need the money, and they need it in short order. So what you do, you ask the client before you even put their money to work in the market. You say, hey, by the way, do you need any of these funds in the next 24 months? And if they say, yeah, I need $200,000 for a down payment, that's it. You say, well, we're not investing that $200,000. We're keeping that in cash or a CD. No risk, no downside exposure, and the rest we'll put to work for you, because that's the responsible thing to do. And when you're not making a commission, that's what you advise the client. But our friends at Edward Jones, I got to tell you, I'm not picking on them, but I've seen so many clients come in with a disaster, a hodgepodge of nonsense that they've been sold by our friends at EJ, that I don't have the best view of this firm. But again, all brokerage commission firms, they operate in very much the same way, all right? So I'm not trying to pick on them by themselves, but just be aware that when you're managing your finances through somebody else and they're advising you on some kind of cockamamie move to stay invested when you clearly don't want risk, you got to ask yourself, where are their incentives? And are they working for me or are they working for themselves? Okay? Way too common of an issue. I see it all the time, and I wish it never happened, but here we are. So, if you're hanging out, guys, smash that like button, subscribe to the channel. I appreciate you guys hanging out. And again, feel free to call in. The number is on the screen. I don't bite. If you have questions you want to add to the conversation, you want to comment on experience that you've had, feel free to call in. We'd love to hear from you. If you want to be the brave soul who's the first to call in, then more power to you. All right. So with that, we're going to focus these last 15 minutes on a common question that I get as an advisor, and that has to do with 1099 versus the good old W-2. Let's read. This is from the tax subreddit and comes from none other than Wanderbutts. Oh, man. All right. We can't disappoint Wanderbutts, right? So I just graduated, and I'm recently employed as a dentist. Oh, that explains it. My situation, I'm kidding, guys. My situation currently is that my employer wants to hire me as a 1099. From my understanding so far, I will have to pay self-employment taxes as an independent contractor, among other things I'd miss out on if I was an employee with a W-2. I wanted to bring it up to my employer, but I had a few questions. Is it okay for me to continue as a 1099 even though a general dentist cannot be considered an independent contractor under the IRS criteria? Okay. Should I negotiate a higher pay if they're adamant about me being a 1099? And if I stay with a 1099, how would I calculate how much more to negotiate to account for self-employment taxes? Because there's a difference, right, in being paid as an employee versus being paid as a contractor in the way the taxes play out, which we're going to take a look at. I grew up financially illiterate and recently have been trying to learn and understand finance and taxes more now that it applies to me. All right, a few great questions here. And we have a dentist who's considering W-2 versus 1099. Now, this first question here is a little interesting because the IRS does not have criteria in terms of who can be a 1099 in terms of an independent contractor versus W-2 income. The IRS doesn't care which one's which. What they're concerned with is, from an employment law perspective, does an individual qualify as an employee of a particular business or as a contractor? Now, technically, it's often viewed that if you're performing the primary function, so if you're working for a dental office and you're a dentist, you're performing the primary function of that business, and you're using their tools, meaning their machines, their equipment, their office, and so forth, and they determine when you come in, what your hours are, and they have a substantial amount of control over your working there, then it could be argued that there's no choice in terms of the classification, that they're required to pay you and classify you as an employee, along with all of the protections that go along with it, whether they like it or not. But in some cases, depending on the facts and circumstances, it may be argued that a dentist could potentially be a 1099 independent contractor of the dental office, particularly if that dentist provides services for, let's say, 15 dental offices, right? In that case, it can be argued that they're actually independent, right? And if they determine their hours and they pay for some of the equipment that's used, or they provide their own equipment, then you may make that argument. But to be clear, there's no specific IRS criteria that says a dentist can or can't be an independent contractor. The distinction is whether, from the overall situation, all of the facts and everything else, employee or independent contractor. It's not a choice in many cases from a tax perspective, even though there are so many businesses that will put this choice to the employee. They'll say, I'll pay as a W-2 or 1099, whatever you want. Truth is, paying someone as an employee is much more expensive because in many cases you have to provide benefits, you have to give paid leave in some cases, you have to provide health care. All of those other things that are perks for employees may come into play. The other aspect is now you're paying employment taxes as the employer. So many businesses will want to structure their employment relationships as independent contractor relationships to save on taxes, among other things. But the first issue is that it might be illegal because the person actually is functioning as an employee and they should be paid and classified as such. The other aspect is that in these situations, sometimes when someone is being paid as a 1099, they aren't being properly compensated. I've seen so many situations where a client will say, and these are smart people, okay, so this person offered me $100,000 as a W-2 or $100,000 as a contractor. Which one should I choose? Whoa, that is a wild choice because obviously as a contractor, you're going to be subject to higher taxes, including self-employment tax. So the compensation should be greater. But let's put some numbers to that, because one of these questions is, if I stay with 1099, how would I be able to calculate how much more to negotiate for compensation? Let's take a look. And for that, let's bring up the good old tax software and run some numbers. So in the first scenario, we're going to assume $500,000 because doctors make a good amount of money in wages. Okay, so this is W-2 income, $500,000, no federal withholdings. We're going to assume that there are no withholdings just so we can compare apples to apples in this case, okay? So $500,000 W-2 compensation. Let's look at the tax return. Now, specifically, we're using single filing status, not much else going on with the return. As you can see, all $500,000 in wages. We got the standard deduction going on. Life is good. Taxable income, $487,450. Now, as we go through the return, what we want to focus on is the total amount due, okay? Because again, we assume no withholdings, so this is a good clean number for us to focus on, which is $145,152. And we're going to track that in a handy dandy spreadsheet, okay? Now, let's do the work. I already ran some numbers here, as you can see, but we're looking at W-2 compensation with the amount of $500,000. All right, and the federal tax on that, $145,152. Okay, so the income net of tax in this case is $354,848. All right, so now we got a baseline number. Now we want to compare it to the 1099 scenario. Let's do that. For that, we're going to get the wages, get them out of here. All right, we're not concerned with that anymore. And we're going to go to Schedule C because that's where independent contractors who don't have a business entity in place, such as the partnership or an S corp, that's where they report the income. And we're going to mark that there's $500,000 in income just to compare what it would look like if the numbers were the same. And of course, as we're going through here, being that this is a dental practice, we're marking it as a specified service trade or business for qualified business income or QBI purposes. And it's a qualified trade or business. Don't worry about that if that's a little above where you guys are in terms of understanding this stuff, but it affects the QBI deduction in many cases, so we want to make sure we take that into account. So $500,000 of independent contractor income. Now we can see that the income moved from line 1 to this amount here. So business income is $500,000. And how does this affect the return? Well, if we look at the amount that's due, it's now increased to $173,164. So if we run the numbers, $173,164, we can see that the difference is $28,000 in terms of the additional tax burden. So the income net of tax is $326 as opposed to $354. That's the hit you take if you ask for the same amount as a contractor as you would as a W-2 employee. So on the other hand, there's a common misconception that, oh, self-employment taxes are 15.3%, so you just ask for 15.3% more. Is that the case? Well, let's take a look. Now, when we run the numbers here, what we're going to do is change the 1099 income amount to $550,000. And see what happens. All right, so now the federal tax is going to be different. Let's take a look at how that plays out. All right, so $550,000. Okay, let's go back to the return. And we can see now that we have $550,000 coming from Schedule 1, which is coming from Schedule C. Let's see what the amount due turns out to be. In this case, it's $192,183. Okay. And then when you look at the net of tax amount, because now we're comparing $550,000 as an independent contractor to $500,000 as a W-2 employee, you'll see that the income net of tax is almost right on par. We're almost there. All right. So if we bump it up to $555,000, let's see where we are, because right now, which one is higher? We have the income net of tax. So actually 550 is a little much. So if we do 545, all right, let's see what effect that has. All right, so 545, and we can run the numbers here all day, guys. The point is 190,282. Okay, that's close enough. All right, so the break-even point here would essentially be $545,000. Again, not taking into account any of the other expenses that go along with being self-employed, but that's the point at which the compensation as an independent contractor would be fairly on par. Again, not taking into account the employment benefits and everything else, just pure federal tax, with being paid $500,000 as a W-2 employee. And you can see there the difference is not 15.3%. Okay, so that's why it's important to run the numbers, because while the percentages are whatever they may be, you'll find that you have to take a deduction. For example, some of the self-employment taxes you're getting as a deduction. So while self-employment tax is $32,303 in this scenario, if you look at Schedule 1, you'll see that $16,152 of that is a deduction. So you'll have increasing income, some additional deductions, and it's a little bit nuanced how it all works out. But that's why we run the numbers and look at the final result to see where we end up. But let's also keep in mind that as a self-employed individual, you get much greater ability to make retirement plan contributions. Let's say you wanted to go crazy with that. What would that look like? Well, let's take a quick look at that. And we'll see that if we look at the adjustments to income, we have the option as a self-employed individual to contribute to a profit sharing plan. So that, for example, is the employer contribution to a 401k plan. In addition, when you have a solo 401k, you can make elective deferrals. Typically, that amount has been $19,500. It's now increased. I believe it's $20,500 now per individual. But if we max that out, given this level of income, look what happened to Schedule A. Now we have contributions to retirement plans of $58,000. This was the limit for 2021. And where does that end up on the return? Well, it reduces taxable income. All right, because you could see Schedule 1 has the amounts of the retirement plan contributions. All right, LaCert is freaking out on me today. So $58,000, if we add that to the 1/2 of self-employment tax, we get $74,152, which ends up on Schedule 1 and then goes to the front of the 1040. So our taxable income has gone down significantly. And let's look at the total tax now. $169,982 versus $192,082. So now we're in the higher tax brackets. We're getting the most bang for a buck in terms of retirement plan contributions. And quick question for you guys, pop quiz. What would be the maximum that this person could contribute as an employee to their 401k in tax year 2021? Is it $58,000? No, it's going to be $19,500. And we can tell that by taking away the profit sharing contribution here and just looking at the employee portion. Now, if we just look at that, we'll see that on Schedule 1, we have the deduction for contributions to self-employed retirement plans of $19,500. And you can see how this all plays out on the worksheet here, but that's how that amount is calculated. This is why LaCert takes care of the heavy lifting, so I can just focus on entertaining and educating you guys. All right. Okay. So going back to the question, we've now figured out that for an equivalent of $500,000 in wages on the W-2, we would need $545,000 in income on the 1099 to get right into the ballpark of parity. And this is just for federal purposes. We'd have to take state into account as well. But this just gives you an idea of how we run the numbers for different scenarios to figure out which one's most advantageous. And this is how we come up with a counter offer in saying that, hey, if you want to compensate me as a 1099, I want $545,000 and not $500,000. Too many independent contractors have made the mistake of getting paid exactly what they were paid as a W-2 employee. Huge problem, and you're missing out on thousands of dollars literally of income. All right. So with that, this brings us to the conclusion of the hour. Tune in next week, Wednesdays, 7 o'clock Pacific, 10 o'clock Eastern. We're going to do yet another Efros Financial Power Hour, and I'm working on getting some amazing guests for you guys. So mark the calendars. It's not going to be me talking all the time. There are going to be other smart, educated, and interesting people that will share their wisdom with you. So stick around and mark that calendar. If you like this video, you're sticking around, like it, subscribe to the channel, drop comments down below. I love reading your comments. And as always, thank you guys for watching. I appreciate it. Hopefully this was helpful. Thanks for watching.